Robert Sinche, he's Global Head of Foreign Exchange Strategy at Royal Bank of Scotland in Singapore. Robert, thanks a lot for joining us. First of all, 3 years on from the Lehman collapse, 5 years on since the housing bubble in the States went pop, and, well, a second quarter for the Greek economy which saw a contraction of over 7%. What sort of mess are we in?
Well, certainly it's kind of mess that that was outlined pretty well by Ken Rogoff and Carmen Reinhardt in their seminal work on what to expect after debt buildups and a work-off of over-debted economies. And I think that's what we're going through, and it gets tougher and tougher to get that momentum restarted each time we go through this process.
Right. Well, you know, is the U.S. economy only going to grow if we keep on injecting or having stimulus injected into it?
Well, I think it depends on what we want to define as growth. Certainly, I think it looks like we're moving back into the 2% range. Certainly, that's the view of our U.S. team for the second half of the year. Those trade numbers looked awfully good out of the States yesterday. That should help, at least from an accounting perspective, the GDP numbers. So it looks like we're probably somewhere in the 2.5% range for the second half of the year, which is better, but certainly not the kind of levels of growth you need to bring down unemployment and get people excited around the world. But look, the U.S. is no longer going to be the source of demand growth around the world. We know that. We in the States are certainly hoping that the rest of the world, and particularly this dynamic area of the world, is what really drives demand growth as we go forward and helps with some of that global rebalancing we've all been looking for the last decade or more.
Robert, what part is the dollar playing in that, given that I think you had a piece recently saying that it's a less weak U.S. dollar, and it's surprising that it is less weak given the economic background?
Well, certainly I think the downside in the U.S. economy has been well known through the first half of the year. Obviously, the weak dollar against major currencies resulting from the QE2 efforts that started late last year. I think the new news for the FX markets, at least the G10 FX markets, is the slowdown that your piece on Mr. Trichet just focused on with heightened risks. The heightened risks used to be the heightened risks to the upside for inflation. Now the heightened risks are the downside for growth. So clearly a change of tone out of the ECB, and I think that's bringing the euro broadly lower. And in that context, the dollar looks a little bit better versus the euro.
Robert, just also tell me how important is this data out of China is going to be, these inflation numbers in particular, which are due at the bottom of the hour. How closely will you be looking at them?
I think this is really a key issue. Inflation in this region, in the Asian region, critical. Because obviously central banks have been in a restraining mode during the first half of the year. To the extent that inflation pressures stabilize and start to come down, that will allow central banks to take their foot off the brake a little bit. That should allow growth to pick up. At the same time, we have U.S. growth starting to look a little bit better. I think that's a more stable environment as we go forward, working off the assumption that inflation is peaking out around the world, at least headline inflation, and again, that allows Asian central banks to focus a little bit less on restraint and allow those economies to continue to grow a little bit more rapidly.
Robert, thanks so much for your time. Robert Sinche there, Royal Bank of Scotland, Head of Global Foreign Exchange Strategy.